Expressway to financial freedom. What is the expressway? It's a multi-lane fast highway without crossroads. It connects the starting point with the destination. And our destination is ultimately financial freedom. Financial freedom is we are no more required to work to earn our living. Well, the starting point is the day we start earning money. That's starting our profession. Now, there are toll posts on any expressway, and in our case here, there are intermediate goals like buying house, children's education, profession expansion, wedding of our children, and exits are temporary setbacks like illnesses and professional setbacks. Wealth creation has three important components. One is earning, second is preservation, and third is multiplication. Earning I need not talk about, we are all very experts in your profession and you are making enough money from your profession. But preservation has two components. One is to avoid extravagant expenses or purchases of products of show off, and second is to avoid wastage of your money through taxes. And multiplication, of course, I will touch upon various asset classes and what gives you the best returns. This seminar is only for educational purpose. It should not be considered as financial planning or investment advice. Speakers or organizers are not responsible for the outcome of any investment decision taken by the participants. Please consult your professional financial advisor before taking any investment decision. Some of the concepts may not be agreeable to some participants, or they may be having opposing views. If you do not agree with something, you don't need to take it home, and I request you to please bear with me. I will be sharing some investment concepts with you, and it may not be construed as a dictum or as the only right way. There are more than one ways to financial heaven. If there are some errors, then they are inadvertent, and please overlook them. I know my limitations as orator, but still, I'm sure most of you will carry home with some new points after my talk. Doctors are good at wealth creation, but they are not good at multiplication. They have a limited knowledge of finance, investment, borrowing, or expansion of own profession. Most are self-employed and need to provide for repayment of loans, taxes, hospital and family running expenses, contingencies, children's education, or settlement during active earning years or retirement. Now let us start understanding the basic concepts of investment. Let us see what is power of compounding. If I invest rupees 1,000 and if my rate of return or rate of interest is 12%, after 10 years, my corpus will grow to 3,262 rupees. After 20 years, it will not be 6,500. It will be 10,641 because I have not withdrawn the interest and let that interest get reinvested. So my capital along with the interest gets reinvested over the time and it multiplies. And at the end of 30 years, it will be whooping 34,711. So the power of compounding, one has to understand, to stay invested for a long time is the mantra. Longer the duration, bigger the effect of compounding. If I start saving 1,000 rupees a month at the age of 25, and if my return on investment is 15%, at my age of 60, it would be 1.23 crores. If I start 5 years later at 30, the same amount of investment, the same rate of return, but the corpus will grow only to 60 lakhs. And if I start 5 years later at 35, same amount, same return of interest, corpus will grow only to 29 lakhs. So the carry home message from this slide is start early and stay invested for a longer time. Now let us see if I do it a monthly systematic investment like SIP, or I do it in lump sum once a year. Amount is same, 60,000 rupees a year, but Dr. A invests 5,000 rupees every month, while the Dr. B, who is slightly lazy and casual, he invests 60,000 rupees once in a block in a year. Now duration of the investment is same, 30 years. Rate of return is same, 12%. But Dr. A has made 360 contributions in 30 years, while Dr. B has made only 30 contributions in a lifetime. So the final corpus for Dr. A, who has made more number of contributions periodically, his corpus grows to 1.74 crores, while Dr. B, his corpus grows only to 1.44 crores. That is 21% less. So, longer duration, stay invested for a long time, do periodic investment, sort of SIP. Now, what should be our goals of investment? First and foremost, any investment should outpace the inflation. So, currently, I will come to inflation in the next slide, but wealth must averagely, how do you calculate proper growth of your wealth? It should quadruple in 1 decade, or it should double in 5 years. Then difference in the pre-tax returns and post-tax returns should be minimum. You should have a mechanism to protect the wealth from sudden liability or volatility in the markets, or from your personal calamities like a sudden loss of, sudden fines arising from medical legal suits. Fourth is transmission of wealth to the next generation should be hassle-free. You have worked your way hard to earn a corpus which should be passed on to your beneficiaries without any hassle. Now, inflation is nothing but the rate at which currency loses its value. Its purchasing power is lost. And that value is nothing but purchasing power. One has to pay more for the same amount of goods or services over a period of time. I need not talk about inflation. We all see the prices of fuel in India, at what pace they are inflating. Now, government gives 50% weightage to consumer price index when it calculates and announces the rate of inflation. And 50% weightage is given to food and beverages. We belong to the elite class of the society, and food and beverages is not the only part we spend from our earnings. It's hardly 10-15% of our monthly expenses. For us, education of our children, our own health care, medical care, leisure holidays, club memberships, they are all growing at 15 to 16% annually. So, for an elite society like doctors, the inflation you have to average between food and beverage inflation plus lifestyle inflation. So, roughly it comes to minimum 12% average. Now, what is post-tax and post-inflation return? If I keep 100 rupees in a term deposit or a fixed deposit and earn 8% annual return, after 1 year, it's okay, it will go to 108, 100 being my invested amount and 8 rupees as interest. But a tax slab of 30%, I have not considered cess and surcharge here. Out of 8 rupees interest which I have earned, I will have to shell out 2 rupees 40 paisa towards income tax. So my net return reduces to 5.6. Now consider 5% as a government figure of CPI, Consumer Price Index. Out of 5 rupees and 60 paisas which are left post-tax, I will lose another 5 rupees because the value of the money will go down by 5% every year. So my return post-tax and post-inflation is 0.6. Now if you consider lifestyle inflation here, your return will become negative because it's nearly 12%. So post-tax and post-inflation return is a very important concept in investing in investment in any assets. Now there are normally two types of assets which we deal with. One is asset creation product, and second part which we discussed some time back about preservation. So protecting your assets is also very important. So two types of products we consider. One is asset creation products and the other is asset protection product. Now what are in assets? There are three types of finances. Three types of assets. One is a financial asset, second is physical assets, and third is alternative assets. Amongst the financial assets, cash in the bank, fixed deposits, direct equity or shares, various bonds, either corporate or bank bonds, mutual funds, post office savings, pension fund savings, etc. Over the decades, Indians are very fond of investing in physical assets. And physical assets being gold, real estate, bullion, that is diamond, silver, platinum, jewelry, etc. And alternative assets which are coming up of late, like high yield debts, non-convertible debentures, private equity funds, venture capital funds, hedge funds, real estate investment trusts, which I am going to touch upon in the end. Asset protection products are nothing but you have to insure your wealth. And there are various types of insurances available. One is a term insurance to protect your own life. Amongst all the insurances which we do for protecting or guarding our life, the best and the only one is term insurance. Otherwise, insurance is not an investment tool. Never think of money back policies or unit linked investment plans. Please start your life insurance early, and that should be only term insurance. The earlier you start, lower will be the premium. Second is medical insurance, mediclaims. You must insure your own life as well as life of all the dependents in your family. We are all doctors, we invest heavily in our hospitals, so you need to protect and guard the damages to the hospital due to various natural or violence by the patients. Fire and theft insurance, professional indemnity insurance, most important. You should insure yourself adequately considering the clientage you draw and the type of services you offer and the rates, professional charges you charge. Jewelry and valuable insurance. Those who are exposed heavily in the stock markets, those who have large equity portfolio, they should think of hedging their portfolio by appropriate measures in future and F&O hedging for guarding your equities. And cash in the bank remains the best asset protected asset. Now let us see the returns from various asset classes in last 30 years. Equity, direct equity gives you the best returns. Next best is public provident fund. Third is gold. And last one is the fixed deposits. We have not considered real estate here because the appreciation in real estate depends on various innumerable factors which vary from place to place. Now, this is a very important slide. If you had invested 20 lakh rupees in 1980 in various different asset classes, 20 lakhs in fixed deposit would have multiplied 20 times, giving you annualized return of 8.39%. But in last 30 years, from 1980 to 2015, the average inflation rate was 7.67%. So your net return is only 0.72%. Here it is only post-inflation adjusted return. It is not a post-tax return. Now consider gold. It would have grown, invested amount is 1 lakh. After 35 years, it has grown to 20 lakhs. Gold has grown to 37 lakhs, giving you annualized return of 10.21%. Adjusted against inflation of 7.67%, its net return is 2.54%. For silver, it's just 1.35%. And for direct equity, Sensex is 10.33%. Now, if you hold your money in a cash form, unaccounted form, it degrows. The value of that money, 1 lakh, has grown to 5,208 in last 35 years, giving you a net return of minus 95%. So, as a professional, and if you are a smart investor, you should never hold cash in any form. Now, you all know these are the various income tax slab rates. The new regime which is going to be introduced this year will have this slab rates, and the new regime is this and the old regime is this. I would strongly suggest to all my colleagues to stick to the old regime because it entitles us to avail of all the benefits under various sections, which the new regime does not. We are professionals, we are self-employed, and we have no choice to switch over to the old regime once we opt for a new regime. Now look at this slide. Surcharge. Those who have annual taxable income of less than 50 lakhs, they have no surcharge. But there is cess, health and education cess. So their final, maximum tax slab will be 31.2% if they are taxed at 30%. Those who have a net income of more than 50 lakhs but less than a crore, their slab rate, net rate will be 34.32%. Those who have an income of more than a crore but less than 2 crores, nearly 36%. More than 2 crores but less than 5 crores is 39%. And more than 5 crores is 42.74 crores. Why did I put this slide? To make you understand that out of every 1 rupee you make above 5 crores, you are losing 43 paisa. So you are carrying home only 57 paisas. It's a very heavy tax outgo. How are you going to save it? You have to think of redistribution of income amongst your family members by some means. And that's the aim of putting up this slide. Now, how are you going to plan to save your taxes? How are you going to redistribute your income amongst your various family members? Utilization of maximum income slabs for your family members. Government has given this good scheme to professionals, 44ADA, where your professional receipts, if they are less than 50 lakhs, and if you give tax on presumed profit of 50%, there will be no books of accounts required to be maintained. So Section 44ADA is a boon for professionals. How? I will explain to you in the next example. Whether you are utilizing the benefit of Hindu undivided family, this is another taxable entity you can create. Now, what is the message for doctors who are having their own enterprises? Those who are consultants in big corporate hospitals or public charitable trust hospitals have very less options. But they can always have a Hindu undivided family. But those who are having their own setups in cities, Pune, Aurangabad, Nagar, Nasik, or any district or taluka place, they have a lot of options to play with. The doctor who is working in the hospital should not own the premises of the hospital. He should be just the part of the entity which runs the hospital. And the part of entity which runs the diagnostic service or pharmacy he should not be. You can rope in your other family members, your wife if she is not a doctor, to run all these things. Appropriate model means a model which is fit for your organization with available avenues and by which the tax liability will be minimal. Unfortunately, I have not yet met a chartered accountant who has given me an advice how to save taxes. They just, whatever we present to them, they do a clerical job, submit our returns and charge their fees. Incidentally, in one of the seminars where I was talking on shares, I met one young chartered accountant, Chinmay Kelkar from Pune, and he made a fantastic presentation on how you should save as doctors on your income tax outgo. And this was a very interesting presentation by him. Setups having turnover of more than 1 crore, they should have a model of partnership plus proprietorship. A turnover having a turnover of between 2.5 to 4 crores, you can have 2 proprietorships and a partnership. Here we assume that there are at least 2 doctors involved in that setup. And setups involving more doctors as consultants, then you can have a private limited company plus a partnership model. So this is just a baseline. I am giving you an idea. You can further discuss this with your chartered accountants. Now I will give an example how you save on taxes. Please attend to this slide carefully. This is the proprietorship model which I was running till now. Now if I see, I own an orthopedic hospital in the city of Pune, and if my IPD sell is 1 crore 50 lakhs annually, my OPD collection is say 15 lakhs annually, my physiotherapy collection say is 20 lakhs rupees annually, medical store is 45 lakhs, and the total turnover comes to about 2 crores and 30 lakhs, out of which my hospital expenses is around 90 lakhs. My physio I employ good physiotherapists, invest in equipment, their outgo is around 10 lakhs a year. Medical store expenses around 31 lakhs 50,000 a year. My total expenses are 1 crore 31 lakhs and 50,000, and my taxable income comes to 98 lakh 50,000, and my tax outgo would be around 28 lakhs. Now I have become smarter. I conduct my OPD to avail of benefit 44 ADA provision. It is only on consultation practices I use the proprietorship model, while my hospital is now being run by a partnership firm in which my non-medico relatives in the family or my wife who is earning is much less than me, she can be a part of this. And this is a partnership income, this is an individual income. Now let us see what has happened. My indoor receipts have gone. I make 15 lakhs from the OPD as before. I make 20 lakhs from physiotherapy as before. I need not show any expense here because on a total income of 35 lakhs, which is less than 50 lakhs, presumptive tax comes to only 17 lakh 50,000. Presumptive profit comes to 17 lakhs 50,000, and my tax liability comes down to 3 lakhs and 40,000. Now you look at the hospital income. It's 1 crore 50 lakhs, out of which 45 lakhs comes from, apart from that 45 lakhs comes from medical store. The total turnover is reduced from 230 to 195. Hospital expenses remain same, 90 lakhs. Physio clinic expenses have gone in the proprietorship model, which I need not elaborate upon. Medical store expenses remain same. And now, since the partners have come, my non-medico partner, who is a working partner, gets a salary of 5 lakhs. A salary of 5 lakhs remains again non-taxable. So, my total expenses are now 1 crore 26 lakhs 50,000. My profit for the year becomes 68 lakh 50,000, and the tax outgo comes to 18 lakhs 70,000. So, how much I have saved on the tax is 5 lakhs 70,000. That's nearly 50,000 rupees a month. So this is just a basic idea which I have given. You can have n number of partners, you can pay them salary, you can reduce your profit, keep your partners under non-taxable range. Another option, those who are working and getting all their income by checks can have a Hindu undivided family. In India, many families are undivided, and incomes earned by such families can be joint incomes. These incomes cannot be taxed in the hands of any specific individual, but in the hands of a family. First and foremost, you have an additional PAN card, so additional slab rates, and it's a legitimate way of creating additional tax entity. Additional card means additional benefits. How do you create HUF? Apply for the PAN card first. On a stamp paper, make a HUF deed. Banks may ask you, income tax department does not ask. You have to name a karta. I am married. The moment I get married, even before I have children, the HUF comes into existence automatically. You have to just give it a formal structure now. So you become a karta. Normally a male becomes a karta of any HUF, but now according to the Supreme Court recent judgment, even a lady can become a karta of a HUF. All these years, a widow lady only could become a karta of HUF. You have to name other co-partners. I have 2 daughters. Both the daughters can be co-partners. If I adopt a child, adopted child cannot become a co-partner. He can only become a member. Now, how to create the HUF? Apply for the PAN card first, create a HUF deed, and open a bank account, preferably in a nationalized bank. How do you create a capital? If you have ancestral property, if you have inherited property from your parents, if your wife has inherited property from her parents, that can be added to the hodgepodge of the HP. It is called a hodgepodge of the HUF, and the capital is already created. But if you do not inherit such any business or ancestral property, you can create the capital for HUF by accepting gifts from your blood relatives or from your wife's first blood relatives. Any gift which is beyond 50,000 from any non-relative will be taxed in hands of the recipient, that means you. So you have to arrange for gifts from your parents, grandparents, wife's parents. Now HUF can do any business, can invest in shares, mutual funds, can invest in real estate. But real estate is not a good idea because all co-partners and partners of the HUF need not have cordial relations all their life. The title may come into trouble because of the disputes amongst the partners or co-partners, rental income, and various other sources. Salary income is not permissible for HUF, and HUF cannot have the same business as Karta. Four generations in the same family, four descendants can be a part of HUF, they can be co-partners. Assets in the name of HUF are the assets of the family and not of a specific individual. All the members of HUF have a right in the property. That's why I told you not to have real estate in the name of HUF, because the differences or the disputes in the family can be troublesome. HUF is required to file a return of income tax and tax audit if the turnover of the business is more than 1 crore. Adopted child I have already talked about, he cannot ask for the partition of HUF. HUF is not recognized in Kerala, and HUF is automatically allowed only to, Hindus, Buddhas, Sikhs and Jains. HUF is not allowed for other religions. Now let us see an example. Dr. Lalit, who is married, has an income of 26 lakhs. 20 lakhs from his profession and 6 lakhs from the ancestral property or whatever it is. We all claim full benefit under ATC of 1,50,000 rupees. Deduction under 80D, that's towards Mediclaim, that's 20,000 rupees. So the net taxable income becomes 24 lakhs and 30,000. Tax on this amount would be 5,54,000 plus cess. So total tax liability comes to 5,70,000. Now consider the next example. Actually that 6 lakhs which was coming to his income was belonging to HUF, but he had never done it till today. Now he realizes the importance of creating a HUF, an additional tax entity, and 6 lakhs have split out. You see now, all other items nearly remain the same. HUF can utilize 1,50,000 ATC benefits independently, either in National Savings Certificate or ELSS, Equity Linked Savings Scheme. HUF is not allowed to have a public provident fund account. So your net outgo comes to 4,05,820. So the difference is 1,65,000. On an income of 26 lakh rupees a year, he is saving 1,65,000 rupees in form of taxes in a year just by creating one additional entity. Now, how can HUF be used by those who are attached to big corporate hospitals or public charitable trust hospitals and they don't have their own setups? This HUF can come handy to lend you money. How? I will explain to you in the next slide. Those who have very high check income and no outgo due to expenses can now think of high-end cars. Why buy them? Take them on lease. See, in India, car leasing has come into existence. These are the ads from the net I have collected. Maruti, Mercedes, BMW, Audi, all have started leasing vehicles. All these years they were leasing these vehicles only to companies with established track records. But now they have started leasing these vehicles to individuals as well, because probably downturn in the business they suffered in lockdown. Now see, when you buy a, say, S-class Mercedes, its on-the-road price is around 70 lakhs. You buy a car on loan, you shell out 10 lakh rupees as margin money. 60 lakhs you borrow. Your monthly EMI for 5 years on a sum of 60 lakhs currently works at around 1,27,000. But the same E-Class Mercedes, I discussed with my own dealer in Pune, BU Bandari. He gives me a brand new Mercedes as a monthly lease of 1,25,000 rupees. Now, if you pay an EMI of 1,27,000, you claim depreciation of 15% every year on a car price. So, over 5 years, your total depreciation amount is, say, 39 lakhs. How much do you save in the form of taxes? 30,62,000. Am I right? Now, 10 lakhs you have paid from your pocket on day one as a margin money. In 5 years, you are losing an interest on those 10 lakhs of about 4 lakhs. You are spending on zero-day insurance plus annual servicing. That costs around 6,25,000 in 5 years. And plus every 30 to 35,000 kilometers, you are changing the battery and tires, that additional 3 lakhs. So this 10 lakhs plus this is again 13 lakhs. So whatever you have saved in the form of taxes on depreciation, you have already made it for. So net gain 0. When you lease a car, your monthly outgo is 1,25,000, and doctors have that they can put your transportation and conveyance charges totally under the head of expenses. Over 5 years, your outgo is 75 lakhs. You have saved 26,25,000 rupees in the form of taxes. Okay, I don't want to buy a car on lease. You create a HUF, you have a very high check income. You can lend money to your own HUF and charge 7%, 8% simple interest from the HUF. If you don't charge the interest, the income tax officer might apply provisions of clubbing, and your income, the interest earning generated by that entity will be added to your income, and there will be no gain for you. So it is always wise, if you lend money to your non-earning wife or HUF or to your minor children, always ensure that you recover some practical rate of interest, may it be a simple rate instead of a compound rate. But you must always make a stamp paper agreement and charge them the rate of interest, then see what happens. Now, your HUF or your non-earning wife, she buys a Mercedes, she gives to you. These are the current rates in Pune. If you take a Mercedes on lease, say 4 hours and 40 kilometers a day, they charge 4,500 rupees. For 8 hours, they charge 7,500 rupees. And for outstation, they charge you 60 rupees per kilometer. Whenever you book any cab to go outstation or anywhere, you have to give them a guarantee of 250 to 300 kilometers. Again, there are no restrictions. So, your wife or HUF buys a car, registered it commercially, and you can use it as a taxi, paying them 15,000 to 18,000, 1 lakh, 60 into 300 will be 18,000. So 18,000 rupees a day as transportation and conveyance. Nobody can object to it. There is a physician doctor in Pune who did this trick many years ago, and he won a case against the income tax department because his wife, who was a stage actress, she bought a car and he used it on lease and paid a rent. These are the current rates of luxury vehicles, release rates per day in Pune. So that's another idea. You can use HUF or your non-earning wife to earn a lot of money, and you can redistribute your income. Now the same logic applies to any, those who have a good volume of joint replacement surgeries. Why buy a robo? Negotiate a deal with the company and take it on lease. It will be a total expense for you. So instead of taking benefits under the head of depreciation, it is much wiser to claim higher benefits under lease agreements. Please think over it. Now ATC, we all know, equity linked savings schemes is the best option because it is market linked and markets always give you better returns, though there may be some temporary setbacks here and there, like in Harshad Mehta scam or 2008 subprime scam, but still, markets will always give you better return. Second best is public provident fund because it gives you a protection against any medical legal suits. No court can bring attachment to your PPF accounts. And Sukanya Samruddhi Yojana. Now let us consider the benefits of various asset classes and the returns from those asset classes. Equity gives you the best opportunity to save your taxes again. Equity-oriented mutual funds or direct equity, the shares which are listed on the stock exchanges, if you hold them for less than 12 months, you will be taxed at only 15% short-term capital gains. You buy a share at price A and sell it at price B, and if B is higher than A, B minus A, 15% of that amount is only your short-term capital gains tax. Now, if you hold it for more than 12 months, you will be taxed only at 10%. See, otherwise, your interest, your dividends, they will be all taxed at your normal slab rates, which is going to be 35% or maybe even 42%. But here, it is only 15% or 10% plus surcharge and cess. For unlisted shares, like if you are holding a share in unlisted company or a private limited company, like I have a private limited company, Pioneer Medilazers Private Limited. If I want to sell my shares in the market, they are not listed. But if I don't hold them for more than 24 months, I will be charged at my usual slab rate. But if I hold it for more than 24 months, I will be charged only 20% with indexation. Indexation is inflation adjusted value, purchase price. Gold. Gold held in physical form, if you hold it for more than 36 months, then you will be charged 20% with indexation. And if you hold it for less than 36 months, at usual slab rates. Holding gold in physical form makes no sense for me. Making and breaking the jewelry is straight 30% loss. So gold in physical form, strict no-no for me. I will always hold gold either in the form of exchange traded fund or sovereign gold bond. If you hold a sovereign gold bond for less than 36 months, again, you will be taxed at the slab rate. More than 36 months, 20% with indexation. But if you hold it till maturity, maturity period for sovereign gold bond, which is issued by the Reserve Bank of India, is 8 years. You get an annual interest of 2.5% only, it is taxable, but the capital gains at the end of 8 years is totally tax-free. So if you want to hold gold for a long term, you should always buy sovereign gold bond. And if your horizon is less, I will tell you next what to do. Now, there are two types of mutual funds. One are equity mutual funds, the other are debt mutual funds, where you invest in debt. If you do not hold a debt fund for, mutual fund held not for more than 36 months, you will be charged at the slab rates. But if you hold it for more than 36 months, it will be 20% with indexation benefit. So we have seen the taxation of various asset classes. Now, if you keep all your money in the banks, either in the savings account or in fixed deposits or recurring deposits, you will get a benefit of only 10,000 rupees under section 80 TT for saving account interest. All your money in the fixed deposits and recurring deposits will be added to your income without any tax benefits. So taxation and interest income from the banks is poor, it's very costly for us. Interest income from bonds or bank deposits are treated as income from other sources. Corporate bonds issued by public or private companies are taxable as per slab rates on accrual basis, except tax-free bonds issued by some institutions like National Highway Authority, Rural Electrification Corporation, etc. And profit or loss from the sale of bonds is taxable under capital gains. Now, this is one interesting thing. People are fond of physical assets. People invest in rental properties. Yes, there are some tax benefits here in the rental income. May it be residential or commercial or industrial, or may it be just open land, basis of tax again is annual value, which is determined either by rent actually received by you or reasonable amount for which the property can be leased out according to the ready reckoner rates of government. On any rental income, 30% standard deduction is allowed. So if you earn 18 lakhs as a rental income, 30% of will be deducted from it as a standard deduction, and remaining 12 lakhs only will be taxed in your hands. If the owner has borrowed money for the purchase, construction or renovation of the property, interest payable is deductible. Borrowing could be from financial institution or it could be even from any person. Taxation of dividend income. Now the dividend income from the shares is taxed in the hands of recipients. Dividend distribution tax has been abolished. Section 80 CCD. How many of you have National Pension Scheme account? Please raise your hand. Only one, because he has attended my MOECon Wealth conference probably. See, this is another avenue where people, those who do not have any knowledge of direct equity or mutual funds also, this is one of the avenues opened by the government itself. And you get an exemption of 50,000 rupees per year. So that's a saving of 20,000 rupees for 40% slab people. If anyone employed or otherwise invests this amount in National Pension Scheme Tier 1 account or Atal Pension Scheme, you get total deduction of 50,000 rupees from your taxable income. It is transparent, it is simple, it is portable, and it's regulated. Like public provident fund, the amount you invest up to 50,000 is totally exempted from tax. The returns you generate till your retirement are totally exempted from tax, and the amount you withdraw at the maturity of the account, you are allowed to withdraw only 60% of the maturity sum. Remaining 40% you have to surrender to any annuity which give you pension all through your life, and only on your death your successors will claim that amount. It's a voluntary pension scheme regulated by Pension Fund Regulatory Development Authority. It was introduced in 2004 for the government employees, but from 2009 it was extended to all. Anyone above the age of 18 and less than 60 can open this account. You get extra tax benefit. You get EEE category of benefit. Now, overall planning of finances will always depend on age, status, whether you are employed, self-employed or entrepreneur, your stability of income, your family responsibilities, your additional source of income if any, financial goals and risk appetite. We have seen the direct equity gives the best returns as an asset class. It also gives you best benefits as far as returns, taxation of the returns on equity is concerned. Buying a share is like buying a piece of business. Buying this piece of business will depend on demand and supply of that share, which is known as market dynamics. It will depend on the strength of the brand that company makes. Colgate, Bajaj Auto, Voltas, all these big brands in different fields we know. Its profitability, borrowing by the company, returns on investments, cash flow from the operations, quality of management of the company, growth in the top line, that means revenue, and growth in the bottom line means net profit, that gives you earning per share and returns to the shareholder. How can you make money from share market? Dividend. I never buy any share for dividend. I buy it only for capital appreciation, and I always hold them for a long time because long-term capital gain is just 10%. Companies doing well will also reward the shareholders by allotting free shares, that is known as bonus shares, or they can issue shares at a discount to market price, which is what is known as rights issue. Bajaj Finserv, the share which is quoting at 10,000 rupees today, offered rights just 5 years back to us at rupees 650. 650 has grown to 10,000 in 5 years. Time in the market is more important than timing the market. Tax benefits, we have already discussed about it. Now, what advantage investment in share market gives? You know, you have sold a share in big profit and you have to pay heavy tax. You can adjust your short-term and long-term capital gains in such a way that your tax outgo will be reduced. You have to be a smart investor, keep tracking your portfolio, hold minimum number of shares, 25 to 30 in your portfolio, study their buying price and market price, and you can always adjust the short term. You see, the short term capital loss can be adjusted against long term capital gain as well as short term capital gain. So this gives you a good advantage in the share market to minimize your tax outgo. Now coming to mutual funds, I'm going to talk more about it because average investor finds it difficult to choose a share, but it's easier to choose a mutual fund. We have all seen there are 2-3 types of mutual funds. According to asset type, the shares, the money which we pay to the fund manager, he pulls such money from lots of investors and then invests it either in shares or in government securities or in private bonds, or it can be a mixture like, hybrid funds. So you have debt funds where all the money will be invested in corporate bonds or government securities. You have hybrid funds where partly the money will be invested in equity or debt. Then you have money market funds and you have equity funds. So let us talk more about equity funds and hybrid funds. Plus now you have index funds where there are 2 stock exchanges in India, National Stock Exchange and Bombay Stock Exchange. Bombay Stock Exchange has its own index which is known as Sensex, which comprises 30 leading companies, and each company forms a part of that index according to the weight of its market capitalization. Reliance, HDFC Bank are number 1 or number 2 heavyweight share companies in Sensex. Similarly, National Stock Exchange has a list of 50 companies included in its Sensex, and that is known as Nifty 50. So you have 2 indices, Nifty and Sensex, and these index fund managers, they don't have to use their brains. They know what are the constituents of this index, and they invest your money in the same proportion in these companies as the index is comprised of. So the expense ratio of index fund is very less. So they don't charge you heavy fees for investing your money, and your returns ultimately are better. And if you see it over the long term, index funds will give you better returns than most of the professionally managed funds. Overseas equity funds, this is a recent trend where ICICI Prudential, Franklin Templeton, Motilal Oswal, they have come out with overseas equity fund, and they invest your money in foreign companies and returns are fantastic, but the taxation is not very friendly. These are large. What are the types of equity oriented funds? Investment in large companies is large cap funds. Investment in mid cap funds is in mid-sized companies, and small cap funds is small market capitalization companies. Now if you see the risk to return ratio, low risk is low return, that is large cap. Multi-cap funds, slightly more risk than the large cap because the investment is diversified, but returns are better. Mid-cap funds, returns are still better, but the risk is also higher. And investment in small cap funds, highest risk, but highest return. So nothing comes without a risk. Debt funds are much less risky because the money is invested in debt where you earn a regular interest, minimum holding period to avoid short-term capital gains is 3 years. Liquid funds are, it's like a savings account. We park our money in very, very short-term funds. Gilt funds is government securities, very safe. Now, how do you select a fund? This is very important. If you open Economic Times Monday, Investor's Guide, or a Business Line on a Sunday, or websites, Value Research or Morningstar, you will get all the details of any fund of any fund manager. You have to see a category of fund, whether it's a large cap fund, mid cap fund, multi cap fund. Then how old is the fund? It's existing for last 3 years, 5 years, 10 years. Anything which is less than 3 years, don't put very high amounts in short or young funds. Then see the assets under management. Any good fund will have at least 3,000 crores to manage. They have a better stability and better, they can dictate terms even to the companies. Return to the investors in last 3 to 5 years. That is very important. All this information is readily available in Investor's Guide of Economic Times, Value Research, Morningstar, expense ratio. Maximum expense ratio around is 2 to 2.2% of most of the funds. Then who is managing the fund? What are his credentials? That is also information available on Google. Portfolio of the fund manager. जिस फंड के लिए आप अप्लाई कर रहे हो उस फंड में कौन से शेयर्स है? What is the reputation of those companies and stability? And this is most important, which you must not be knowing. What is the risk adjusted return of any fund? Alpha, beta, what is its standard deviation, and what is Sharpe's ratio? You need not know what is it actually. This information is also, if you go to value research and press on risk adjusted returns column, you will get this information immediately. It is a tool that measures standard deviation or dispersion of the fund portfolio from the expected return. Now, if the fund is invested in large cap stocks, you know what are the returns you are getting from large cap stocks, Sensex, and how much this fund is deviating from the returns of that particular benchmark. So if a fund has a standard deviation of 7% and average return of 15%, that means the returns can deviate from 8% to 22%. Lesser the standard deviation, more stable is the fund. Higher the standard deviation, less stable is the fund. Sharpe's ratio, it compares the returns you get from the fund and the returns you get from a safe investment like bank deposit or government security. So it's a fund return minus risk-free return divided by standard deviation. Sharpe's ratio per se on its own does not have much value. But when you open, large cap funds portfolio and if you see 10 script funds, the best Sharpe's, one which gives you a more Sharpe's ratio value is a better fund for you because it is giving you more returns per risk you are taking. Alpha, it measures the excess return that your fund has generated as compared to the benchmark. If your alpha is 5, that means your fund is giving you 5% more return than the benchmark. So higher the alpha, better for you. Beta is the index of volatility. If the Sensex is fallen by 10%, but your portfolio has fallen only by 2%, that means its beta is very good. If the Sensex has fallen by 10% and your portfolio has fallen by 20%, not good, beta is very high. So you should select a low beta when the markets are very high. Your portfolio will remain stable. But when the markets are low, you should put in high beta because when the market rises, your returns will multiply. So that's a common sense. You have to choose between the stability and the returns. Now let us come to investment in the real estate. All these years, Indians preferred direct investment in this asset class because of lack of alternative options in the financial markets. Buying and holding physical real assets. This is also another interesting concept and interesting slide. Whether I should buy shares or whether I should buy a house, that's a question to almost all young investors. So if you invest 100 rupees in a house and 100 rupees in share, the advantage here for housing, you will get loan from any financial institution. So you have to just put 10 to 20% as a margin money. While shares, nobody is going to give you a loan to buy shares. You have to put all 100% from your pocket. If you put 20%, you will borrow 80% from the financial institution. And at the end of 1 year, your house may appreciate only by 10% and shares may appreciate by 12%. But see now the ultimate return. You have given 7 rupees as an interest on a housing loan. Still, your gain is 3 rupees. Shares, all 12 rupees is your gain. But for getting 3 rupees, you have invested only 20 rupees. While here, for gaining 12 rupees, you have put 100 rupees. So return on investment, if you see, it's always better on a borrowed house. Here we have not considered other tax concessions which you get under ATC towards home loan repayment and on interest under section 24. If it is a first house, you get up 2 lakh rupees of tax concessions on interest. Now what is real estate investment trust? It's a mutual fund of real estate. We do not go and buy a piece here and piece there. In lifetime we buy 1, 2 or maximum 3 real estate properties. But it is an investment trust, it's like a mutual fund which operates and manages a portfolio of income generating properties for regular returns to the investors. They buy offices, shops, malls, hotels. These are usually commercial properties which generate regular rental income. And a real estate investment trust pools funds from a number of investors and invests them in rent generating properties. SEBI requires Indian REITs to be listed on the exchanges now, and there are two real estate investment trusts which are already listed on the stock exchanges. One is Embassy Park and the other is Mindspace. Initially, when you were required to invest in REIT, the minimum ticket size was 2 lakh rupees. Now, since the units are available on the stock markets, you can buy even 1 unit of any real estate investment trust. Just like mutual funds, REITs are subjected to 3-tier structure: a sponsor, a fund manager, and a trustee. What advantage real estate investment trust offers you is asset diversification, geographic diversification, developer diversification. It has a collective negotiating power, so you get lower prices, secured repayment, higher due diligence because they have a legal team all the time available with them. There is active management and control, and overall lower overhead costs. What it does not offer you is investment making decision. So you may be able to invest in REITs in primary or secondary market and exit anytime you want now because they are listed. Previously, the minimum ticket size was 2 lakhs, it no more exists now. For any REI to be formed, it requires a minimum asset size of 250 crores. Now, this is an important slide, you can take a photograph of it. I have some money and I want to invest in stocks, and depends on the tenure, what class of asset you are going to choose depends entirely on the tenure of investment. If you want to invest for less than 6 months, better keep it in savings account in bank or liquid funds. Anything between 6 months to 2 years, you can put in debt funds or gilt funds which have a very high safety. Anything between 2 and 5 years, you can invest in balanced funds or hybrid funds. Part of it will be in equity, part of it will be in debt. If your horizon is 5 to 7 years, large cap stocks. Between 7 and 10 years, it will be mid cap stocks. And more than 10 years, it will be small cap stocks because your returns will be very high. Gold, I think I have talked about a lot. This is one thing which is new. People who are scared of putting money in share markets because of volatility, sudden rise and fall, structured products is a fantastic concept. They are specially designed debentures. They have a specific objective and they are designed to counter volatility of the markets. It's like an insurance of your portfolio. They may also multiply gains when the markets rise. Now look at the scenario 1. There are 2 types of the market linked debentures. 1, they invest in the index, or 2, they invest in the derivatives, that is futures and options. If you give 100 rupees to a fund manager for an investment, he will put say 77 rupees in a debt which will give you return of 10% per year over 3 years. That 77 rupees will grow to 100 rupees. That means you have given them 100 rupees and that 100 rupees will come back to you through debt route because he is investing 77 out of that in a very safe product. But remaining 23 rupees, he will invest in an index, say NSE Nifty. Now if Nifty gives you 30% returns in 3 years, your 23 rupees will become 30 rupees. So on maturity, you have got 100 rupees from the debt and 30 rupees from the index. So your total gain is 30 rupees. You get back 130 rupees. If Nifty falls 30%, then your 23 rupees will become 16 rupees. And your maturity amount will become 100 plus 16, that is 116. So it will be at par with your returns from the bank. So this is one way, this is known as index-linked debenture. Now look at the scenario 2. Again, rupees 77 which you have given to a fund manager will go to the debt product and it will grow to 100 as before. but balance rupees 23 is used by the fund manager to buy a call option. It's a derivative product. Now in 23 rupees he can buy 2 call options. We as retail investors are allowed to buy futures and options only with expiry of 3 months. But the asset managing companies can buy futures and options for 3 years. So that's the privilege only they have. So if he buys 2 call options of 11.50, that means 23 rupees, he is participating 200% in that Nifty call. Now if Nifty generates 30% returns in 3 years, 2 call options will give him 30 plus 30, 60 rupees, and plus your 100 rupees will come back. So your total return will be 60 rupees plus 100 rupees, you will get back 160 rupees in place of 100. But if your Nifty falls below that level, then you get 0. That's the risk of futures and options, but you are still getting your 100 rupees back. So your capital is protected, but your gains can be multiplied. So these are known as structured products. They are linked to debentures. What are the risks? Liquidity is very poor. Once you buy it, you are stuck for 3 years. Ticket size is huge. If you are a new investor in the stock market, with your investment corpus of less than 5 crores, you have to invest minimum 1 crore. But if you already have a portfolio of more than 5 crores in the form of mutual funds or shares, then your ticket size can be reduced till 25 lakhs. Now, at what age, what should be your investment? If you are young, between 25 and 40, put minimum money in debt, put maximum in equity. You can take a picture of this. Debt investment in young age should be minimum. After 65, it should be maximum. Equity, young age 40 to 80%, old age minimum. Gold should never be more than 10%. Real estate in young age, yes. You don't require to buy any new real estate after 65. Young age, you have to buy a mediclaim, professional indemnity, plus term insurance. In old age, only mediclaim. And cash, 6 months of expenses in young age, while 12 months of expenses in old age. Common mistakes made by the doctors: they look at insurance as an investment. They buy insurance for non-earning members like children or non-earning spouses. They buy insurance out of social obligation from acquaintance or a relative. They do not define age to retire. They do not diversify. Instead, pump a lot of money in profession and at times borrow it. They do not track performance of their own investments. Your total loan amount should not exceed 7 to 10 times the net annual income. Your EMI should not be more than 40%, ideally around 30 to 35% of net carry home income. Always buy residential real estate only on single name, because lot of benefits, income tax benefits, are only to the first holder, and income tax officer can always harass you if joint names are seen on any transactions. Investing on oneself is essential with accelerated pace of change in the professional environment. Possibility of becoming professionally redundant is real today. Reskilling and upskilling in the profession is mandatory. I thank you very much